Welcome to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Here's your host, Grant Bledsoe.
Hello, everybody. Grant Bledsoe here. Welcome back to Grow Money Business. This week's episode is number 87. And this week on the podcast, I'm trying something a little bit different, a little bit new. We're going to do a top 10 list of my top 10 behavioral biases that impact your investment decision-making negatively. Top 10 lists are something that you might remember from David Letterman's late night show years ago. It's something that I grew up watching, and I thought would be kind of a fun way to, or a fun format to communicate some of the information I wanted to talk about on the podcast. So this week we're talking about psychology and emotion and how that gets in the way of sound decision-making. I hope you enjoy it. Hey, everybody. Real quick before we jump into today's episode, I have been advised by my attorneys to remind you all that none of what you might hear in today or any other episode of Grow Money Business is financial, investing, tax, legal, fitness, or even relationship advice. It's content that you're free to use and deploy on your own terms. And before you take any actions on what we might cover in the show, I really encourage you to consult with your accountant, attorney, or financial planner. If you don't have a financial planner and think that you might need one, be sure to check out threeoakswealth.com to learn more about my firm's planning, advice, and investment services. All right, so today on the podcast, we're talking about investment biases. And another way of putting that is ways that our feeble human brains and psychology and emotional makeup as human beings get in the way of sound investment decision-making. This is something that just happens to all of us. There are so many emotional and psychological factors based on how we're wired and what our life experience has been like that impact how we see the world and the lens through which we view investments that may be taking place in your own life, in your own accounts, in your retirement accounts. Any of this, just in general, the way that we view the world is really substantially impacted by our life experiences. And in the investing context, that is absolutely true. And I can tell you, after working with a lot of people over a lot of years, that is just something that comes up really, really frequently. Now, I grew up in an age where the late night TV people were Jay Leno and David Letterman. And I thought it would be kind of fun this week to put this episode in the context of a top 10 list that David Letterman was famous for when he had his show on CBS for years and years and years. And I can't remember off the top of my head whether he did a top 10 list every single night or whether it was maybe a couple times a week. But it was a really funny segment on his show for years and years and years. And I thought it would be somewhat interesting to cover this concept of emotional behavioral investment biases that get in the way of investment decision making in the form of a top 10 list, because there are a lot of them out there. There are definitely more than 10, but I'll try to boil them into the top 10 that I run into and see in my practice. And maybe that will shed some light on what we might think about as ways to reach sound investment decisions and avoid some of these problems in our own investment decision-making. So the first one that I want to cover here, number 10 on our top 10 list, is oversimplification. And before I jump into this one, I just a little forewarning. When we go through this list, you're going to notice some commonalities between these. And the fundamental commonality here is that our human brains are wired in a couple of really interesting ways. One of them is that we have limited brain capacity as humans. And so anytime we're trying to synthesize information or store something to memory or do some, brain heavy activity, our brains are trying to perform that activity in the most efficient way. And there's also this concept of, hundreds of thousands of years of our lizard brain developing and evolving on Earth. And we have these innate tendencies that go back to survival instincts because human beings had to survive over hundreds of thousands of years. And so, we feel anxiety because our ancestors, if they heard, a crunch in the leaves, that might mean that there's, a predator out to get them. And that kind of stuff is as biologists and so forth will tell you, is just kind of hardwired into our DNA after having to deal with that for hundreds of thousands of years. So as I understand it, that's the genesis for a lot of these issues that we run into when trying to make sound investment decisions. Nonetheless, number 10 on our list is oversimplification. And the idea with oversimplification, again, in that vein of trying to process information in the most efficient way, is our brains are overwhelmed these days. And so we rarely want the full picture. What we want is a soundbite. And when I say we, what I mean is our brains naturally want to distill information down into more bite-sized pieces. Because if we really thoroughly understand a topic or a subject or an investment, that's great if you're dealing with it all the time. But if you don't have a whole lot of time and energy to take a look at something, if you're reading, a document covering, a mutual fund that you might invest in for the first and only time, your brain is naturally going to try to boil that down into a couple of bullet points that you might store to memory. And that kind of oversimplification gets in the way of sound decision making, because the world is a complex place. The investment markets are complex. We're very complex creatures, human beings are. And that tendency to oversimplify just naturally gets in the way of making a sound, objective decision. Number 9 on the list is restraint. And restraint, again, goes back to, hundreds of thousands of years ago. If food and water are scarce and you need food and water to survive, when you get into a place where there is food and water, you want to hoard it, because it's only, fairly recently in the history of human beings where there's been ample food and water for much of the world. And obviously there are a lot of people out there who don't have ample food and water, which is a different subject entirely. But in general, when we come across an opportunity that we think is beneficial to us, it's very hard to show restraint. We're just greedy as human beings naturally. And so if you come across an investment decision that appears to be a surefire winner, as your cousin who gambles in the markets would probably put it, I say that jokingly, we almost always overestimate our abilities to show restraint. Cryptocurrency is a good one recently, because for a while there, it seemed like all these cryptocurrencies would do nothing but go up. And the game for a lot of people was trying to figure out how much they could put into cryptocurrency. So it didn't matter which one, what was going to grow the most that day, and therefore how much leverage could they really apply to the cryptocurrency markets. And that's a pretty good example of not showing very good restraint. And a lot of the crypto coins have pulled back over the last couple months. The investment merits of cryptocurrency is a topic for another day on the podcast. But the bias here that we run into, and the problem that gets in the way of our sound investment decision making, is our overestimation of our ability to show restraint. That leads us down dangerous paths when we think we're showing restraint, but we're really not, and we're getting in the way of our own best efforts and heading down a path that is not quite as balanced as we might think. Number 8 on our list is familiarity. And, the funny thing about this one in particular is a lot of people I talk to about investing acknowledge familiarity bias, but are in complete denial that they're exhibiting familiarity bias. And what it means is that we naturally trend toward investments that we know and are familiar with. And so if you work in the oil industry, it's really common that you want to invest in oil stuff because you know what's going on and you understand it. You might not want to invest in banks or technology because you don't understand that as well. When the opportunities, in finance or tech or any of these other sectors, even if they're far better than the opportunities in the oil industry, you still want to invest in oil because that's what you're familiar with. And the way that I see this play out more commonly than that rough example is investing in non-U.S. stocks. I see a whole lot of people who are invested almost exclusively or entirely exclusively in stocks here in the U.S. They have no diversification overseas, and that's a big mistake in my opinion. It's an easy way to obtain some diversification and reduce risk in a portfolio, but as a lot of people will tell me, I don't understand what's going on in India. I may not understand everything about what's going on here in the U.S., but I know it a lot better because I live here. I don't want to invest in it in a country that I don't understand. When the benefits of diversifying, especially if you're using ETFs or mutual funds, particularly index funds that are just going to invest in the entire country without needing to understand the nuances of sectors or different companies or anything like that, it yields a huge diversification benefit, which simply just reduces risk for the same amount of return. So that's a familiarity is something that I run across all the time and is one that we need to be especially cognizant of. Number 7 is incentive bias. And this is one that's it's not exactly tied to our own innate human psychology and emotional makeup leading us to bad decisions. It's more structural in nature. And incentive bias basically says that there are all these perverse incentives in our financial system that lead people to make decisions that kind of push them toward folly in the aggregate. And the best example I can think of there is the way that the banking and mortgage system was set up prior to the mortgage crisis in 2008 and 2009. And if you've seen any of the movies or read anything about how mortgages were set up at the time, mortgage originators, so the people who were getting borrowers to sign on the dotted line and originating the mortgage, which they were doing on behalf of an origination company. Usually they would only hold that loan for like a day or two and then turn around and sell it to another party who was buying the mortgage in exchange for a fee. So if you're a mortgage originator in that time, you were doing really well, making a lot of money. But as you might remember, the underwriting standards were really, really misaligned with what the system should have, how the system should have been set up. And the acronym of the day was NINJA, meaning that a lot of people were borrowing money to buy houses with no income and no job. NINJA. And so these ninja loans were being distributed to people who knew that they couldn't pay the mortgage, but a lot of them were also negative amortization loans, meaning that you're paying less than the interest accruing on the loan, and the balance just continued to accrue and grow. Or there was some kind of balloon payment that people didn't appreciate or understand and couldn't make later on. And so quite obviously, now in retrospect, quite obviously, we as a country were issuing mortgages to people who were not qualified to take them out and borrow the money. But the originators were incentivized to do so because every single mortgage that they originated resulted in cash in their pocket, cash money. And so they didn't care because they turned around and sold the mortgage to another company or Freddie Mac or Fannie Mae, one of the government-sponsored entities. So this whole thing was being subsidized by government-sponsored entities, and it was just a huge misalignment of incentives. And that's incentive bias. The originators were doing things that were good for them, but really bad for the system, as we've come to find out, and hurt a lot of people across the country. Number 6 is self-attribution bias. This is another one that's kind of funny, and we see all the time. Maybe it's not that funny, but when things go well in our lives, in our investment accounts, or otherwise, we like to think that it's because of our efforts and our actions and our decisions. But when things don't go right, we like to think that that's because of external factors exclusively. And so we have this what's called self-attribution bias because we have egos as human beings. And again, I kind of hearken back to the development of, maybe not development, but evolution of humans over hundreds of thousands of years. And it seems to me, as someone who's totally uneducated in this stuff, that ego just plays a big part into survival hundreds of thousands of years ago. And we just have egos ingrained in our DNA, in our brains, and that's where this comes from. But as it relates to self-attribution, we don't like to think that we're responsible for bad things happening, and we do like to think that we're responsible for good things happening, even when the good result had nothing to do with our efforts. It was, we were on a boat in a rising tide, and our steering of the boat really had nothing to do with the fact that things were going well. And that's another pretty poor analogy. I'm just coming up with these on the fly, if you couldn't tell already. But that's one that we have to be aware of, because if we, I see this a lot with people day trading these days. People are making money hand over fist day trading because the markets are going up. It's pretty easy to make money when you're putting cash into an investment, a stock or an ETF, small cap, large cap, doesn't matter. When the whole market's going up, it doesn't matter whether you're buying and holding or whether you're going in and out frequently. When the tide is rising, you're going to make money unless you're going short or are trying to be market neutral across the board. And when the market is not doing well, day traders don't do so well either. But a lot of people out there, and I'm talking to a fair amount who have family members, relatives, friends doing this, and they're tempted to do so themselves. A lot of people out there are day trading, making pretty good money at it, and saying, hey, I could do this as a full-time job. Why doesn't everybody do this? This is easy money. And the fact is, it's easy money right now, or it seems like it is, but your abilities as a day trader are probably not as good as you think they are. And the fact that you're making money is simply because the market's strong, not because of your ability to read charts or technical indicators. Don't mean to offend anybody or your day trading prowess, but I've seen this before. I'll leave it at that. Information bias is number 5. And information bias has to do with picking and choosing what information is relevant to a sound investment decision. This kind of goes back to correlation versus causation. Correlation is not always causation, is an example of this. But a lot of people out there make investment decisions based on information that's just simply not relevant to what's going on. And part of a good investment analyst and manager is the ability to decide what information is relevant versus irrelevant. It's exceptionally hard to do. But when we pick the wrong information to use to confirm or deny a hypothesis and draw a conclusion and make an investment decision, if we don't use the right information, it's going to lead us astray. One example might be if you're trying to say, well, should I buy Apple stock or not? And, the information you probably want to look at is the strength of their balance sheet. You'd want to look at their income statement. You'd want to look at supply and demand dynamics in the market. You'd want to look at their supply chain. That's a big deal for Apple. You'd probably want to look at what else? Supply chain, particularly supply chain constraints. Anything that has to do with their products and income sales. But there are people out there in the world who will try to evaluate whether or not they should buy Apple shares, and they'll say, you know what, my cousin really didn't like his last iPhone. I think that their products are deteriorating and their growth is not going to be as high as it's been in the past because my cousin didn't like his iPhone. That's not the right piece of information to use when making that decision. It could be, your cousin could be an accurate representative of the whole market. That may wind up being true, but that's not the information I would use to make that decision. Nonetheless, it's an example of how people sometimes make investment decisions. So we need to use information that's relevant, and it's exceptionally hard to do. But the bias is that we typically don't, and that's because it's exceptionally hard to do. Okay, number 4, groupthink. Groupthink is when we don't make good decisions because the herd has an opinion that differs from what the sound decision is. Excuse me. And we avoid making the sound decision or drawing the sound conclusion because everybody else is doing something different. And naturally, we as humans like to be in groups. We like to be part of the herd. It's uncomfortable to go against the grain and go against what the herd is doing. Because it's a survival thing from years ago. You're more likely to survive in a group of 50 other people working together, protecting each other from predators, than we are operating as individuals left to our own devices to fend off potential predators. But at any rate, it's uncomfortable for us to have an opinion that's totally different than everybody else. And Warren Buffett has a good story he tells about this specifically. I'll probably butcher it, but the story is about an oil prospector. And so the oil prospector dies and is waiting at the gates of heaven to get in with a bunch of other oil prospectors. Let's call it 100 other oil prospectors. And so there's 101 of these oil prospectors waiting at the gates of heaven. And then suddenly the crowd disperses and all the other oil prospectors run away. And so St. Peter comes over to this oil prospector and says, why did they disperse? What happened here? And the prospector says, well, it's simple. I told them that there was oil that had been discovered in hell. And so they all ran down there. And so then St. Peter kind of nods and says, oh, that's interesting. Why don't you tell me why would you like to be in heaven? And so the oil prospector thinks about it for a minute, and he thinks about it for another minute, and he says, you know what? On second thought, I think that rumor about the oil in hell might be true. I'm actually going to go down there. And that's a good example of what we do with our investment decisions. When popular opinion is trending in one way, we don't like to go against the grain that much. There are people out there who naturally are contrarians, and if the crowd is doing one thing, it doesn't matter what logic says or what their own opinions are. They will just automatically, by default, without even thinking about it, do the opposite of that. But that's not a very good tactic either. The whole the trick to sound investment decision making is always being open to new ideas, not being impacted by what the herd is doing, and synthesizing those ideas, that information, ignoring the irrelevant information, and coming up with a sound conclusion based on research and analysis and data. And the fact that we like to be in groups just makes it hard to be objective and to go against the crowd. Number 3 on our top 10 list of investing behavioral biases is anchoring bias. And this is another one. It's very natural. It happens not just in investing, but everywhere. And when we come to a decision or draw a conclusion based on thought, if we're taking the time and energy to research something and come to a decision, we like to be anchored on that decision. And I'll give you a personal example here. So my wife and I are looking at installing solar panels on the roof of our home, and there are a bunch of different outfits that you can go to. There are subcontractors, there are larger national companies, there's a bunch of different ways to set it up. And so we're trying to make a good decision for us financially, for our family, and for the future and all that. And it's a lot of work trying to understand how all this is set up. And I feel like I have a pretty good understanding of it now, but it's taken a lot of time and energy for me to read up and feel confident enough to make a reasonable decision. And if a new quote came in from another contractor right now, I think that I would be reluctant to consider it because of the time and effort that it took me to evaluate the first 2 or 3, even if this new quote might be by far the best one. And because we have this limited brain space, we're just trying to synthesize all this stuff. Our brains are trying to synthesize all this stuff efficiently, and it's not efficient. It takes time and energy, calories and brain power to consider new information and new ideas as they come forth. But as we know, in investing, you always have to be open to new ideas and new information because the world evolves. You can't invest in Apple shares and then, close your eyes and ears to all new information that comes out about the company. You have to kind of stay on top of it if you're going to be an investor in a specific stock like that. And so this tendency to remain anchored on our original conclusion, our original decision, is something that simply gets in the way of making sound decisions. Number 2 on our top 10 list today, loss aversion. The simple way to put this one is that the losses in our investment accounts feel worse than the gains feel good. The magnitude, the amount of emotion that we get from a 25% loss is far greater than the amount of emotion that we get from a 25% gain or a 25% win. And because of that, people make investment decisions very commonly in an attempt to avoid the losses without appreciating the opportunity for potential gains with the same in the same manner. And that leads us to be too conservative. It leads us to be concentrated in specific areas sometimes. And generally, when you have this feeling of anxiety because you lived through the last market crash, I've seen this before, I never want to feel that again, well, that leads you to miss out on a lot of potential gains and returns and opportunities elsewhere in the future. And, that data point of living through the last market crash is no doubt important on not taking too much risk in your overall portfolio. But we need to put this in context too, because the gains never. The gains never feel as good as the losses feel bad. And we just have to put that in context and manage that emotion creeping into our investment decisions. All right, we're down to the number 1 behavioral bias that impacts investment decision making negatively. This is kind of fun. We might do more of these in the future. It's kind of a nice way to organize the information I want to cover on the podcast. So number 1 on our top 10 list is confirmation bias. This is a lot like anchoring bias. Anchoring bias being, again, You come to an initial decision. We don't like to adjust that decision later because our brains are lazy. It takes effort and time and energy to do that. Confirmation bias is not that dissimilar from anchoring bias. We make an investment decision, we make a decision in our lives. When new information comes to light that's relevant to that investment decision, we tend to ignore information that doesn't support the decision and emphasize information that does. And it's also related to the information bias we talked about earlier. It's because our brains are naturally trying to be efficient. It's a positive way to put it. Lazy might be another way to put it. We're not weighting and emphasizing the same information in the same way. And, you see this all the time with all the political stuff on social media is people are just totally closed off to viewpoints and opinions and data and information if it doesn't support their natural stance. And it directly gets in the way of being objective when you're making some of these decisions. And I use the word decisions a lot today in the context of investing. What I mean is, at a high level, what should your accounts look like? What asset classes are you investing in? How much of your investments should you have in various asset classes? What securities should you choose in each of those asset classes to build your portfolio? Are you actively managing this? Are you a long-term strategic asset allocation kind of advisor? When are you rebalancing? How are you handling tax implications? All of those are investment decisions. We kind of like to think of it, an investment decision as, well, what am I going to invest in? What specific security? Am I buying Lowe's, Home Depot, Apple, GM? What looks good? What am I going to invest in? But sound decision-making comes from, there are various ways to do it. Some people go from the bottom up. My preference is from the top down, starting with asset allocation. And when we have confirmation bias, we don't like new information to get in the way of the decision that we've already made. And there's a natural filter that our brains do there that just gets in the way. Charlie Munger has another good quote here, and I'll probably butcher this one. Charlie Munger is Warren Buffett's longtime partner, really famous investor if you've not heard of him. And his quote is, "Rapid destruction of your ideas when the time is right is one of the most valuable qualities that you can acquire. You must force yourself to consider arguments on the other side." And I said I was going to butcher it, but I actually have it written down and I just read it verbatim. So I think that was pretty close. But at any rate, being objective and synthesizing new information without any of these tendencies that our brain tries to impose on us is a really essential quality in any investment decision maker. And I promise that there would be some commonalities across these behavioral biases that we'd cover today, and there certainly are. And, just in general, our human biology, our ancestry, how we've evolved as a species, gives us a lot of emotional and psychological baggage that we have to be cognizant of. And so what this means for investment decision makers like yourselves, definitely for me as a professional, is we have to understand how our feeble lizard brains are pushing our behaviors and emotions around. We need to strive for objectivity at all times, and we need to make investment decisions as a committee, really, and get feedback from other people and help and really strive to have other people keep our baggage in check is probably the best way to put it. We need to keep our emotional and psychological baggage in check. And a lot of it comes from our ancestry. A lot of it comes from our personal lives and upbringing and history. And like I mentioned at the beginning of the episode today, we all view the world through a slightly different lens, and that lens impacts how we make some of these decisions. What information is relevant? What's not relevant? Even though this information might not jive with my conclusion that I've already made, should I pay attention to it? Should I look into it more? Or is it not relevant? The tendency is to brush it aside, of course. All right, so that's it for today. This was kind of fun. I kind of like the top 10 list concept. If you have feedback, head over to growmoneybusiness.com and send it to me. If you didn't like the top 10 list, let me know, and I'll consider ditching it. If you did like it, what other top 10 lists would you like to hear about on the podcast? We've got some good guests coming up over the next couple months, too, so I'm excited about that. And we'll probably return to some investment myths over the next couple months as well. All right, that's it for today. Thanks for listening. Talk to you all again soon.
Thanks for tuning in to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Be sure to subscribe to the podcast on iTunes, Google Play, or wherever you digest podcasts to ensure you don't miss out on future episodes and announcements. And feel free to submit questions to growmoneybusiness.com.